No, it doesn't. This is more noise, and certainly we're seeing the market react a bit, but as you just said, we're not seeing it pull back significantly, and the question is why? The why is the fundamentals remain sound, and that's ultimately what the market responds to. So it's not time to worry yet.
But when, Doug, might the fundamentals, when might this rhetoric turn into a change in those fundamentals that Brad talks about?
Well, I mean, when I look at trade, I look at it sort of a couple directions. First is this a trade war? Is this a war worth fighting? And I think the reality is yes. A lot of trade rules have not been updated since the mid-1990s. In mid-1990s was when China was the sixth largest economy behind both Brazil and Italy. So, you know, things need to change. Those rules predate even the European Union in the euro, or the European Monetary Union in the euro. So we need change. It's one of the few things that, you know, folks like Bernie Sanders and Chuck Schumer and Donald Trump actually all agree on. So I think change needs to happen. Why do we do it now? Because we have the leverage to do it now, and we won't necessarily have the leverage 10 years from now. And not to sound extreme, but we've reached a tipping point where you either fight a trade war or you fight a civil war. And you know, wage disparity, job loss has created a lot of tensions, and you can see that with non-traditional leaders being elected around the world. Our view is, I think you need a non-traditional approach to go after some of these agreements, because what we've been doing for a lot of years hasn't worked. For example, the WTO rules have been debated since 2001, and we still haven't seen a change. So I think.
So I understand your point, and I am sensitive to the idea that the practices and the rules need to change. But my question was really more directed to, at what point does the trade conflict begin to spill over into economic performance, prices, potentially interest rates rising, slower economic activity in a way that it would affect investments?
And I think the way that we see it in the third quarter is going to be a really good proxy for that, is whether we see de-escalation of trade tensions with our allies. Because I think if you're going to fight China and have a significant fight with them, which may sound like it's building up to, you need to have Mexico, you need to have Canada, you need to have Europe, you need to have Japan on your side. And if we see trade tensions continue to de-escalate there, we have a ceasefire with Europe, for example, and obviously the NAFTA discussions are ongoing. If we start to see some of that de-escalate, then all of a sudden you can understand the plan, which is let's first divide, then let's negotiate, and then let's unite against the common enemy, which seems to be China at this point. So if we start to see those trade tensions re-escalate with Europe and with Canada and with Mexico, then I think we got to maybe reframe our argument.